So again, good morning or good afternoon, depending on where you're joining us for the 2026 Fiducian Advisors Outlook. So I will mention, as I mentioned, I'm Brad Long, Chief Investment Officer here at the organization. Maybe just very quick and upfront, you'll notice maybe if you're extremely perceptive, a very modest change on this slide. So on the upper left, Fiducian Advisors, a Wealth Spire company. Those of you that are current clients, prospective clients, or just friends of the firm that have known us for a long time, earlier in the year we went through a transaction in which we are part of a broader organization with Wellspire Advisors. The two, in a number of entities came together to form one entity. I want to make a couple of things clear here, just so there's no confusion. Point one is, if you're a current client of the firm, a lot of what you're going to see or hear or experience has been the exact same way that it's been, call it in multiple years past, probably, over the last decade. So really kind of a lot of continuity and familiarity, with what you've come to expect. Now, as a benefit of the transaction that we went through and the investment resources and colleagues that we brought on, we've also had the opportunity to socialize a lot of this context and information with our Wellspire investment colleagues, and so we've done that together. Now, a year from now, when we're having this conversation, it'll be on a different letterhead and we'll look somewhat different. But I can say, functionally, philosophically, on the root of what we do, there's really very modest change. But for the purposes of today, kind of what you've known in the years past is what you'll see here today, with modest, very modest exception. So just want to acknowledge that out of the gate, so there's no kind of question or confusion. Speaking of out of the gate, so as we get going here, you can ask questions in the prompts. So just put them into the question box. It's anonymous. It comes directly, to us that are running this presentation. So, if you're worried or feel silly, don't worry about it. You can put it in the queue. We'll try to address it as we're going through our presentation, just for time efficiency. If not, we'll keep a little bit of time at the end. And then, as always, if we don't get to your questions in our allotted time, which is about 42 minutes remaining, we're not going anywhere. You can pick up the phone or send an email to your advisor or consultant, and we'd be happy to answer any questions that may be lingering that you may have. Our compliance team couldn't make it, but they sent their very best, and so we want to make sure to acknowledge that. And then again, jokingly, I was talking before our presentation, my somewhat dated picture at this point, but nonetheless, if I haven't had an opportunity to meet you, it's a pleasure to meet you here today. All right, 2026 outlook. So we're going to cover quite a bit in the next 42 minutes. We're going to do a little bit in the rearview mirror. So we're going to look at our 2025 outlook. What did it say? What did it do? And how did we kind of, score it if we went back over the calendar year? And then we're going to jump straight into 2026. So what does this year, will it bring to bear? The opportunities, the risks that are presented, and frankly, how our portfolios are adjusting as a result. So again, as we're going along, if things are coming up, you don't have to wait. Put a question in the queue, and we'll try to get to it as we're going through. So with that, we'll dive straight in. So first, rear view mirror. So 2025 outlook, entitled Bridging the Divide. And we talked about three key themes that we thought would be influencing prices: fragility, durability, and the age of alpha. Now, fragility really showed its head in a meaningful way in April when President Trump walked out on the lawn with a big piece of cardboard and said, here are all the tariffs, or I guess technically reciprocal tariffs, that were being implemented. Markets nearly walked into a bear market, 20 or 19% and change, before they ultimately rebounded. So we did have quite a bit of price volatility in markets, and frankly, the adjacency of fragility and durability, that's by design, right? Coming into the year, full valuations, the intention without the knowledge of what would exactly transpire for policy shifts, the potential risk for inflation, right? So all of those things leading to, frankly, a necessity or a need for durable portfolios. So international diversification was a key theme we talked about last year, prioritizing high quality fixed income portfolios. International did very well relative to the US. Fixed income in aggregate did well, but we saw one of the best years out of bonds, out of intermediate investment grade bonds, up, call it high single digit returns. And we'll talk more about, which is going to be part of the conversation here in 2026, is marketable alternatives and kind of their ability to potentially add to diversification, which goes into the age of alpha, right? Now, that was not a comment on in any given year, you're going to have all active managers outperform. Like, wow, wouldn't that be great? But that's not exactly how the world works. It was more in an environment where concentration is high, valuations are high, the risk for inflation is rising. Those are where you want kind of hands on the steering wheel, proverbial steering wheel of your investment portfolio to make sure that we're managing opportunities and managing risk in an appropriate way. And by and large, that did manifest in 2025. So in the rear view mirror, right, if we kind of give ourselves a grade or on a point scale, right, maybe it was a 7 out of 10 or something, in that ilk, never going to be perfect. But frankly, did set ourselves up for what we think is a really well-established foundation for 2026. I will give you a little bit of the punchline ahead of, the joke, if you will. 2026 will not be coming with material changes. Do not expect wholesale moves or large percentage moves in portfolios. We think the foundation that we laid in 2025 serves not just conditionally for the market that is here in 2026, but well beyond that. And so we're positioned well, and we're expecting very modest shifts in overall portfolios. So enough with the rear view mirror. Time to start looking through the windshield and talk about 2026 in what's to come. So 2026, entitled, the disciplined dividend, right? Really three key themes that we think are going to be influential in how we navigate this environment and, how we take advantage of the opportunities and mitigate the risks where we can. So first, AI playbook. It seems like we can't walk an inch, nonetheless a mile, without talking about AI. And that could be AI in our daily lives, in the workforce, in our job security, or in our investment portfolios. And that seems, at least in the circles in which I traffic and the bubble that I live in, and I recognize to some degree it can be a bubble. It is a very persistent and important conversation. And so what is the AI playbook? How do we manage in today's current environment? I'll give you some of the keys, but we'll start with the facts. And then as we get into NFL playoff season, right, it's how do we run a good offense and how do we run a good defense? And we'll get into each of those. Second is around navigating valuation, right? All else equal, higher valuations is lower forward returns, right? The math is pretty clear in that. So in an environment today where specifically equity valuations are fairly robust, meaning they're high, what do we do about it? How do we mitigate the risks that may produce? How do we take advantage of the opportunities that it may create in navigating, the current environment in which we exist? And then the third is the noise-resistant economy, right? Last year, we threw it at Liberation Day. We closed the federal government. We had some of the largest economic policy shifts since post-World War II. Yet you look at employment, you look at GDP quarter over quarter, year over year, both continue to grow. So the economy continues to be robust. Now, not infallible, and we'll get into that in just a moment, but it is a great foundation for potential growth, both economic growth and growth in markets. So we think these are really going to be the foundations for portfolios and the discussions that we'll have. Now, I will tell you in the allotted time that we have, we'll probably spend a disproportionate amount of time talking about the AI playbook because it feels like it is the predominant discussion and factor, both in questions we're receiving and to be candid, the opportunities and risks that are presented in market, but we'll obviously hit all three of these. Now, as a reminder, right, we are investors, we're allocators, we're not economists, right? We know and focus and care about the economy, but we are not out trying to predict next quarter's inflation number or next quarter's GDP. But as a privilege of the position that we sit in and the resources that we have available to us, we have access to some of the world's greatest economists. And so, one of them is Don Rissmiller, works at a firm called Strategas, which is a sell side investment firm, and they build what they call an economic diffusion index. And those of you that joined us last year, this graphic is likely familiar, in which it encompasses 14 factors that by and large describe the things, in their opinion, that are most important to the growth or shrinking of the economy. And then they simply rank them as assets, so they're good. Liabilities, they're not in good standing, or kind of the messy middle as neutral. You can see here is, maybe a slight deviation towards on the liability side, but a lot kind of sitting in the middle. We could spend the whole day talking about each one of these bullet points, so we won't get into all of them in great expectations, but I will call out two and on the bookends. The first is consumer spending. The U.S. is a consumer-based economy, right? The majority of GDP is generated by consumption. Today, consumption is still remains robust. Now, I will say, if you've read about or heard about the K economy, there is a cohort of spenders that are doing the majority of the lifting. The top 10% of wealthiest individuals here in the United States account for about 50% of consumer spending. And so that cohort is really, continuing to drive consumption. Consumption leads to earnings. Earnings leads to, the potential for higher markets. Now, in that analogy of the K economy, right, the lower leg of the K, if you are not in the top 10 or you have not benefited from owning financial assets, as many of us, and as a product of being on this call, you likely own financial assets. But if you are in a position where you haven't owned financial assets, right, the world hasn't passed you by, right? Real wages continue to grow. But there's no question that milk is more expensive than it was 5 years ago. An automobile is more expensive. Housing is more expensive. So as a consumer, right, incrementally, you are certainly not as well off as the top leg of the K, in which markets have annualized at a very high rate over the last 5 and 10+ years. Now, using some of that spending and inflation and costs and jumping over to the liability side, government deficits is a liability. We have high deficits, higher than 100% debt to GDP here in the United States. And with the trend in politics, right, this idea of affordability being a lightning rod, look at the New York election late last year, look at even recent comments from the administration on capping interest rates on credit cards, on making homes more affordable, maybe limiting the ability for financial buyers to purchase individual homes, right? This will be a lightning rod for politicians coming into the mid-year at the end of this year. Now, that's the bumper sticker is affordability. If you peel the bumper sticker and look at the warning on the back side of that label, it would say something like, addressing affordability to a politician means likely adding more to the deficit, right? It usually comes with, hey, I will give you something. And there's generally not a perfect offset, and it usually leads to more deficits. So that is something that we need to watch for. It does show in our allocations being overweight international on a global basis from an equity perspective with the potential weakening of the US dollar. It means owning real assets. Deficits can be fodder for inflation, which we want to watch out for. And then also our fixed income positioning, both vis-a-vis tips and not owning long dated bonds, as those will be the most exposed to a lot of the deficit discussion. Now, looking across the economy, right, you could spend a lot of time with each of these, but if we look at unemployment, GDP, a number of other factors, the economy is growing, right? There's a lot of things to be excited about. And just from a historical perspective, when we've got data going back into the 1940s, there are two things you usually see that would precede a recession. One is that corporate profits are not growing, right? And today we have growing corporate profits, right? So that is a strong position to be in. And then you see labor start to weaken in a way that it spreads and starts to have rolling layoffs. Now we've heard from AI that is delayed labor hiring or greater profit margins, but we have not seen this kind of infection in labor, and frankly, unemployment remains quite low. So while the economy in this index is not a freight train, right, is not unstoppable, it does continue to grow and serves as a good foundation for portfolios and the opportunity going forward. Now, let's jump ahead here and start to dig into, some of the long-term approach that we take when it comes to capital markets. And as a reminder, right, as investors, we build our portfolios utilizing forward capital market assumptions. So we build 10, 20, or forward-looking assumptions. The benefits of those is A, they are long-term in nature. We don't get caught up in kind of the chasing our tail of short-term data. And B is that they're grounded in empirical evidence, right? So it's not I feel like the S&P is going to do well this year, or maybe, or it just, I don't know how it feels this year, right? We're using evidence-based processes to help guide long-term decisions, which builds kind of a repeatable frame of success. Now, as we look at our capital market assumptions, for 2026 and beyond on a 10-year basis, a couple of primary things we call out. So one, generally moderating expectations. All else equal, higher valuations is lower forward returns. Valuation in a shorthand is expressed in fixed income through yields. So if yields are lower, think of that as like a coupon on a bond or similar. If those are going down, our expectation of forward return is falling. Now, that being said, they're not uniformly going down. Muni high yield here, actually on a forward basis, is going up. And the total return, albeit year over year, has modestly declined. As we look at the yield across fixed income, yields are still fairly robust. Now, this is a 20-year look back. The higher you are on this graph, the more attractive. The lower you are on this graph, the less attractive it is. And you can see from 24 to 25. Now, remember, our capital market assumptions are for 25 were calculated in 2024, and for 2026 were calculated with the data of 2025. So that's why it says 24 and 25. Looking back over the last 20 years, things like cash, the ag, municipal bonds, investment grade bonds are still on an absolute basis yielding something that's quite attractive relative to their history. Now, one of the exceptions within fixed income relative to its history is spread. So on the bottom right. So if you think of a government bond as presumed to be the riskless investment, the basis from which you have a riskless portfolio, and you add to it the likelihood of default for investing, say, in a company, a corporation. That spread is what you're earning above and beyond treasuries. Today, for investment grade bonds and for non-investment grade high yield bonds, that spread is, if not at, pretty close to the low it's been in the last 20 years. That means that all else equal, we're not as attracted to those spaces as we would be if the spread was high. Now, it doesn't mean we don't own it at all. It just means that on a relative and a risk adjusted basis, we want to have more modest allocations in those areas, especially high yield, whereas we prioritize, IG in this instance because spread is that tight. Now, if we go on to the equity side of the ledger, again, 10-year capital market assumptions, looking forward, all else equal, higher valuation is lower, forward expected return. And we do see a modest kind of fall in valuations here. Now, that's not uniform across the basis. Real estate, by way of example, is an area in which, real estate was an underperformer last year, especially relative to the rest of the markets. And so, as we look at forward return expectations, with capital market assumptions where they sit, they are relatively low. Now, context behind that makes a lot of sense, right? No matter how you cut it, we calculate our forward 10-year capital market assumptions based on what's called the cyclically adjusted price to earnings, or CAPE ratio, if you've heard of that before. If you use really any other metric, PE is price to earnings, PB is price to book, price to cash flow, price to sales, and there are many, many others. They are at the upper percentiles of valuation. So on this graphic, kind of the higher you are towards the top, the more expensive it is. And so as we look at kind of forward expectations, there is a reason that forward expectations are modest because valuations are full. Now, some of that we'll talk more about as we dive into the AI playbook, like where some of those full valuations are coming from. And frankly, is that exuberant or not. But if we kind of expunge all of that and just say, hey, with starting valuations where they are, what are my expectations? Our expectations are fairly modest for future expected return. All right, diving into markets and then the three key themes here, which we'll spend, kind of a disproportionate amount of time on the AI playbook. So first, AI, right? Again, we can't walk an inch, nonetheless a mile without talking about AI. So, what do we do about AI as allocators, as investors? We'll talk deeper into this, but first start with the facts and then offense and defense. What does offense look like? What does defense look like? The second, navigating full valuations. So we talked about this already to some degree, but it leads to more global diversification, opportunities outside of the U.S. in global equity markets. It leads to fairly full valuations and high yield fixed income. So it doesn't mean kind of sell it and forget it, but it does mean a more modest allocation there vis-a-vis investment grade, et cetera. So the opportunities and the risks that are presented from full valuation. And then the economy, right? As I mentioned, we threw a lot at it. We shut down the federal government. We had the largest shifts in economic policy and fiscal policy, since World War II, and yet, unemployment remains low, quarter over quarter, year over year. GDP continues to grow. So setting a great foundation for opportunity going forward. So the AI playbook, right? I can tell you that more and more from clients, from advisors, from consultants, we're getting kind of two primary questions. One is AI a bubble? So first, we'll start there. And look, first off, I'll acknowledge and appreciate the fact that a very short, not over-engineered prompt into Copilot, which is the enterprise version of ChatGPT that Fiducian uses, and it said, "Hey, draw an image, a pencil sketch of is artificial intelligence an investment bubble?" And really without much fanfare or fuss, this is what it created. And I think and by the way, the images that I showed you before were also AI generated, but with a little bit more prompting and effort. And there's some pretty incredible things coming out of AI. It is hard as, really just being an awake and engaged citizen to not think and look at some of the things that AI can do, both positive and perhaps negative, and not think, wow, this could be transformative. But it also leads to the question, like, is this a bubble? So for those that truly believe, hey, AI is transformative, you almost have to co-sign that idea with the fact that it is likely to lead to, whether we are in it or not right now, a bubble of some sorts. Because as we look back over time, it could be, the most adjacent and perhaps the most, used analogy is the tech bubble. That was a period of time in which, you did have something truly transformative. The advent of the internet there's no question, it was truly transformative. And it did lead to exuberance and it ultimately led to prices and a decline in market. But similar evidence exists. And you can, take it outside of modern history, right? Well, you can go back to, the expansion of the US railroads. You could do the existence or the advent and the invention of the radio, right? There are many, many examples. But in all those instances, right, a kernel of truth, right, that was truly transformative, led to excitement and exuberance, and markets got ahead of themselves. So to think AI is transformative, you must also almost inevitably have to co-sign the idea that it could produce risk in markets. Now, is it a bubble? We don't know. No one knows. Anyone that tells you they know exactly how AI will all land and come together is either trying to fool you or they are fooling themselves. What we can do is we can look and say, okay, how does this compare to other past periods of time, like the tech bubble. Well, this is actually very different than the tech bubble. The tech bubble was far more speculative. The businesses that were either directly or indirectly related to the internet or the infrastructure behind it were investing without the benefit of accruing earnings or cash flow associated. Whereas NVIDIA is making a ton of money, right? And every quarter, is seemingly analysts put very high expectations out there, and they continue to beat and beat and beat. So these businesses are largely investing in AI through cash flow. We'll see if that persists into 2026 or whether they start to leverage debt to do so. But they're doing so because they're truly receiving economic benefit from investment in these spaces. Now, that's not uniformly applied. If you look at, across markets and in particular, some pockets in private markets, where you do have exuberance, right? You have areas in which, in our outlook, we gave an example of, a startup that was former executives from OpenAI. Out of the gate, they raised $2 billion in capital on a valuation at $10 billion. No product, no revenue, no earnings. A month later, they revalued the company at $50 billion, a 5x from, the month before. Still no product, no earnings, no revenue. It's hard to objectively look at that and say, yeah, that's perfectly rational and reasonable behavior. And so, as with any environment, there are always going to be pockets of exuberance and there will be pockets of rationality. And it's our role to figure out how to navigate through those, which gets us into, again, kind of NFL playoff season, right? What is good offense when it comes to AI in our portfolios, and what is good defense when it comes to AI in our portfolios? So the first is, even before we get into kind of how do we step into offense, we got to start with the facts. And we've had a lot of clients that would, call and say like, hey, I want to get into AI. I want to invest in AI. And the first response should be, you're there, right? Because if you own the S&P 500, if you own small cap US stocks, if you own equities in general, right? Somewhere between almost 40% of the S&P 500 is invested directly or in, call it the AI tangency, right? Through infrastructure, through semiconductors, right? Through kind of that belt and suspenders around AI. But almost 40% of the index is already exposed to AI. So before you would say like, hey, I really want to get in on the game, if you will, you're there, right? If you own these markets, you are there. Russell 3000, which includes small caps here, it's about a third. And just of global stocks, holistically, it's about 25%. Now, to put that into perspective, right? Like the size of that bet, if you will. So past bubbles, right? The most recent, the housing crisis or housing bubble during the GFC. Housing stocks and the financial sector were the primary beneficiaries or recipients of, the idea that housing prices can't go down, right? So those securities did very well. The financial sector was about 20% of the S&P at the time. Now, it was the single largest sector, larger than tech at the time, but it was about 20%. Or you go back to the tech bubble, right? Which I think maybe is over stylized as adjacent to the current environment we're in. But technology, the sector peaked at 34%, in 1999, 2000 at the peak of the tech bubble. So today, as we look at AI and portfolios, it's already there, right? So we need to think about kind of what is the pragmatic way to manage and allocate in an environment in which it already exists in our equity portfolios, and then think about the components of offense and defense in a risk-adjusted way. Now, one of those ways is, as we talk about small caps, right, in the beneficiaries of AI, right? AI can, in theory, right, the ubiquitous availability of intelligence, and I'll use intelligence in air quotes, intelligence could benefit any business at any time and any location of any size, right? There's just no question about it. However, it could disproportionately benefit businesses that are more flexible, right? They're not kind of large, embedded, disparate technology systems and data that is a kind of a percentage of sales. They're not highly reliant on like physical property or inventory. So think of like professional services. And by the way, I'm saying this as a leader and owner of a professional services company. So, those type of businesses are more prevalent in mid cap and small cap stocks. One of the potential reasons that that sector and some of the exuberance that we've been seeing from sell side analysts is accelerating. So here, in this graphic, you can see earnings for the S&P 500 large caps versus the S&P 600 mid and small caps. Historically, like the last number of quarters, has been materially lower for small and mid caps. Now, analyst expectations have materially shifted in that, on a go-forward basis, the expectation is a lot higher that the throughput for benefited earnings in small caps has grown. So, right. So as you think about the flywheel of AI, right, it's not just owning NVIDIA, right? NVIDIA is an important keystone or cog in the wheel of AI, but it's not, the road of benefit of AI does not start and stop with a handful of securities. And so small and mid caps could continue to benefit from that. Also, it's not really has not really been reflective in the valuation of those stocks, right? So expectations are fairly low for small and mid caps, even though the benefit could be accrued materially higher. Now, as we think about offense, right, there's a number of ways we're playing offense. A, we're already in the AI game, right? We own global equities. And B, we've positioned portfolios relative to take advantage of some of those opportunities. But we also have to think about defense, right? With 40% of the S&P in AI or AI related securities, that's a pretty big bet. And as an investor, right, we have to think about what are the ways that things could go wrong because we don't get to control the future. I wish we could, but we don't. And so we have to think about errors. There's type 1 and type 2 errors, right? Is errors of omission or commission. And so as we think about AI and our ability to play defense in AI, right? Not get too far over our skis. We used this graphic to help display some of the benefits. Now, there's a lot going on here, so give me a minute just to walk through it. So what we did is we looked over the past number of years, and admittedly, it's not a robust sample set. It's not a data science in which we have thousands of data points. We've got a handful of years in which we can look at AI and its relative performance, and we've proxied that by the top 10 securities, which are very much AI related, versus call it the 490, right? The remainder of the S&P. So when the top 10 wins, historically, the last few years, how much is it won by relative to the 490, right? How much is it outperforming? And then when the top 10 loses, how much is it losing by relative to the 490? So look at 2022, right? When many kind of growth oriented businesses materially sold off. It's important to remember, right? Some of these securities have been up 20, 30, 50 or more percent. The likelihood that they could go down something similar is just as possible, right? And also, when you think about the basis of diversification, 10 stocks could have a wider distribution of outcomes than 490 stocks. It's the principles of diversification. And so let's zoom in on part of this graphic first to try to explain this concept more. All right. So if you own more of the top 10 and the top 10 wins, meaning it outperforms the 490, right? That's the dark blue line here. And based on its historical percentage of outperformance, you can see the more overweight you are, the better off you are, right? That's just the simple math. But as you look at the light blue line, right, which is you are overweight the top 10, but the top 10 underperforms, the slope of that line is far different. And it gets to this idea of kind of the cost of being right and the cost of being, or the benefit of being right versus the cost of being wrong. And being over exuberant on AI, meaning overweight the top 10, and owning, too little, right, is going to cost you a little bit, but not a lot. Being overweight the top 10 and owning too much and it underperforms is more likely to hurt you. And so as we zoom back out and we look at kind of these quadrants of performance, right? And we think about this, what could the future hold? Because it's not a uniform one track on AI is on a path to outperformance. We know that the world is more variable. And we look under the hood on our portfolios. Today our global equity portfolio is modestly underweight AI and AI related securities. We own a lot of them, right? We just like the market, we still own quite a bit of exposure to that space. Yet, it's not the sole bet that we're making. And so, if you took those two examples, right, top 10, underperforms, right? So AI falters, or at least prices come back a little bit. You could see that you would expect, a pretty material outperformance, call it 200, 300 basis points of excess return. On the flip side, right, if AI outperforms and you're underweight, you would trail a little bit. So suffice it to say, if we're in an environment where in 2026, AI goes through the roof, our global equity portfolios might trail modestly. If we're in an environment where, AI prices maybe come back, or AI securities come back from the stratosphere, right, we would expect to perform more admirably, especially on the downside protection, right? And we have to, as investors, weigh these different outcomes because we don't know what the future may hold. Now, part of, and this is, by the way, this is literally just a grab from last year, right? Is part of when we talk about the ability for some of these companies to continue to succeed is that over time, the air is pretty rare when it comes to continual or perpetual outperformance. So it is not a call by any means, but is to say that as we think about the framework of offense and defense, we need to acknowledge that markets are not linear mechanisms, and what was in the past is not destined to be repeated. What is in the future, and so we weigh those risks accordingly. Now, one of the way to manage those risks, and if you have the opportunity to read our outlook thus far, we do think is through marketable alternatives. So that is admittedly glib word for hedge funds, right? These are asset classes that seek to perform with equity-like returns, but typically doing so with less risk. It's in the name, hedge fund, right? So you take on a little bit less risk than the market. Now, in the rearview mirror, looking back at the largest three drawdowns of the S&P, the EFI, which is Developed International, and EM, just the hedge fund index, right? It's not a particular hedge fund, but on average, they have all outperformed in those periods of drawdown, by a tune, of average of 25%. And so as we sit in an environment in which, we say, okay, the economy is robust, earnings are growing, there's really no reason to run for the hills. Yet we acknowledge some of the things that we just went through. Valuations are high, concentration is high, and kind of the bet on a particular item, specifically AI, is high. How do we manage those? Marketable alternatives is one potential way to do that. Now, we also recognize it is not an appropriate asset class for every single investor that's out there. Some, on an after-tax basis for some, it can be tax inefficient. You can get around that with where you place it, asset placement, or some structures that are more tax efficient. We also know that there's liquidity considerations or fee considerations that should be thoughtfully discussed and considered. Nonetheless, if we strip that for a moment and just talk in the bubble of here we are in markets with full valuations, but a growing and robust economy. What is a way to participate on the upside, but potentially reduce some of the downside risk? Marketable alternatives are one of those ways. So as we start to wrap up here in the last couple minutes, and we'll transition to questions, we'll bring forward a couple of just kind of key themes for portfolios. Again, acknowledging that if you sit on a board or for your personal assets and you're looking at portfolios and relative changes year over year, we're really not expecting material changes. We think we've laid a great foundation from 2025 into 2026. And sometimes the very best action is no action, right? We are not materially shifting portfolios. But as we look at our exposures today and the relative risks and opportunities we have in markets, again, at a period of high valuations, concentration, et cetera, we just acknowledge that, there's no easy, if there ever is easy, but there's no easy money to be made, right? Where maybe we're bottoming post a recession, or we think it's really time to add risk. Like markets are fairly fully valued, and there are a number of exogenous factors out there, right? Maybe the politicization of the Fed or others that are seeking to influence price, and so it's not a time that we really should be reaching and adding a ton to risks. Now, as we look at our portfolios, right, similar to last year, maintaining our overweight to non-US securities, that was certainly beneficial across global equity markets last year, both on a nominal basis, both developed and emerging outperformed US. And then if you adjust for currency, because the dollar was weaker over that time period, it added to that tailwind. And so we're maintaining that position year over year. Additionally, within fixed income, we talked about it for a whole host of reasons, with spreads being tight and potential concerns geopolitically, right? We want to prioritize high quality investment grade fixed income. It also helps serve as a ballast relative to other volatility should it persist or ignite into portfolios. So we have that vis-a-vis our TIPS portfolio, our high quality investment grade portfolios, et cetera. Alternatives, as I mentioned, again, we acknowledge out of the gate, it is not for everyone, whether it's marketable alternatives, which we discussed is an opportunity to potentially participate on the upside without or with the opportunity to reduce some of the downside risk, or some of our long-term secular allocations. Think of private equity or some of the more illiquid asset classes. If you can't stand the illiquidity, there's no point in having a conversation about private equity. If you can, right, it's a conversation we should have, and that in today's environment, we do think, especially lower middle market private equity, there's some pretty material interesting opportunities there. And then finally, with the AI playbook, right, it is likely to be the number one factor in the direction of markets in 2026 and for the foreseeable future. So first, start with the facts. You already got quite a bit of it in your portfolio, whether you know it or not. You have to be thoughtful about what does offense look like, meaning the utilization of whether it's data centers or infrastructure, whether it's small cap, whether it's the potential for China to play in the catch-up game on AI. All those things are offense. The other component is defense, right? Acknowledging that the size of your positioning is the primary determinant of risk, and recognizing how we would position that in portfolios. And so melding those two together, that in a thoughtful way, we can blend both offense and defense to take advantage of opportunities in portfolios. So we saw a number of questions come in along the way. I think we got to many of them, but I'm just going to scroll up quickly and see if we've got other things that we need to address. So let's see from Nathan, your thoughts on don't fight the Treasury or don't fight the Fed, prop up the bond market, be a buyer of long Treasuries now. Great question. I would say, long bonds in particular are going to be the most sensitive to some of the bigger and broader dynamics that are happening in markets. In particular, government deficits, right? So we have OBB coming in this year. That's additive to deficits. I talked about the affordability threat and the midterms that are coming in this year. If any of that leads to more government spending, right, you could have more influence on long bonds. Also, government spending and higher level of deficits tends to be fodder for inflation. If you get any nodes of inflation, and it's been running at a higher level than what the Fed would be comfortable with, you're going to have potential volatility on the long end. And then finally is the politicization of the Fed. We've written extensively about this in 2025. We would say first and foremost, the Fed is still independent, but not infallible, right? We recognize that there are either appointees or components of the Fed that have historically never been perfect, nor will ever be perfect. But that today, for good reason, right, the administration is really hot to trot on the Fed. Removing Fed independence is going to have a lot of influence on fixed income volatility, specifically long bond volatility, and maybe not in a good way. So we would say kind of leave the long bonds in the drawer, focus more on the intermediate part of the curve. There's a lot of opportunity there. So we got a question on historical returns of hedge funds if markets continue to rise. Hedge funds would expect to be, call it in the high single digits, low double digit returns. So if markets are up 20% like they have been in years, you would expect an underperformance. If markets are up five, right, or seven, right, you would expect performance that's in line with expectations. And then conversely, if markets are down 10, 15, something kind of the prototypical, it doesn't have to be earth shattering, drawdown in markets or even a bear market. You would expect in aggregate, right? Not any individual hedge fund, but in aggregate, some outperformance in those markets. And so it's a way to capture more upside, especially if markets continue to follow the economy, which again has been noise resistant and continues to run. So you don't have to, which we would never recommend is like just go to cash, right? Own a lot more cash and just wait from the sidelines, right? Hedge funds can be a great way to participate with potentially moving some risks off the top of the ledger. A couple more questions coming in. We'll see if we can get to all of them and recognizing that we're coming up on time. Okay, so we got a question on the equal weight for the S&P. What would you consider, investors that are, wanting to diversify there? I would say it's a blunt force tool that accomplishes one thing, and it is concentration. Right, so the S&P is objectively concentrated. The top 10 is about 40% of the total index, the highest it's ever been, including 1999. You can't change those facts. The blunt force tool to address concentration is equal weight, which is just one divided by n. So every security in the index gets the exact same weight. One divided by n is not much of an investment thesis, right? It's a very effective tool at addressing concentration, and it's an ineffective tool at building a thoughtful investment thesis. There are many ways to help address concentration. One is just diversification of things other than the S&P, small cap, international, diversifications of things that are not equities, fixed income, alternatives, many things that don't look and act like the top 10 in the S&P. So what the concentration of the index is saying is there is a risk here. So rather than mitigating the risk by a blunt force tool that takes care of concentration, size that risk relative, utilize other assets that can help mitigate that concentration risk where the concentration is not as high, rather than kind of adopting an investment philosophy that is just however many of these things are here, I'll own a little bit of all of them. Because a philosophy of one divided by n is effectively I have no information about what the future will hold, right? No opinion at all. So I'll just own a little bit of everything because I have no opinion. Obviously, we have opinions, and so we don't think that that would be an effective tool, to diversify against concentration. Let's see if we can get any final questions before we have to adjourn here. And I apologize, I'm scrolling through quite a bit and quickly, and I know we're up on time. So why don't we do this? We'll end here. I apologize if we missed some of your questions. I know there was quite a few that came into the queue. As always, if we didn't get to it, either through our remarks or in the Q&A at the end, call or email your advisor. We're happy to address it. We're not going anywhere. We'll make sure that we address those quickly and succinctly. But as always, also, we appreciate your vote of confidence and thought in working with us and joining us here today. We're excited about 2026. There's a lot to come. We think our portfolios are well positioned to manage through what may be, right? We never have a crystal ball, but we do think that we're positioned very well for the future. So again, if we didn't get to your questions, please feel free to reach out. Otherwise, we appreciate your time and thanks so much for joining.